inflation figures and the latest government monthly borrowing statistics on Wednesday the 22nd, and then the monthly retail sales numbers on Friday the 24th, mean we have a few interesting macro data points due from the UK in the coming week. Meanwhile, existing housing sales and new housing sales data on the 21st and 23rd will provide some insight into the US economy. These figures may also be of interest to shareholders in Ferguson and to a lesser degree Ashtead, by the way, as both have exposure to that industry. Another possible top-down headline grabber will be the elections for the European Parliament that run over the 23rd to the 25th of May. But I try to leave politics alone in these updates, and I won't be making an exception in this instance. So that takes us straight on to the company news. We have an absolute deluge of annual general meetings coming up, but scheduled results releases and trading statements are a little thinner on the ground. Nevertheless, names to note could include water utility Severn Trent, and then a trio of retailers in the shape of WH Smith, Tops Tiles and Halfords, all on Tuesday the 21st of May. Another utility SSE, as well as property group Great Portland Estates, Embattled support services firm Babcock and Royal Mail on the 22nd, United Utilities, TalkTalk Telecom and Hollywood Bowl on the 23rd, and finally FTSE 250 Precision Engineer Spectris on Friday the 24th of May. But for all of the interest those names could create, the company that looks most likely to be causing a big fuss in the week ahead is retailer and high street bellwether Marks & Spencer. It is due to release full year results on Wednesday the 22nd of May. It's been another tough 12 months for M&S as the company has accelerated its restructuring plans, seen profit estimates gradually slide lower and cut its interim dividend, of which more shortly. The shares are now trading very close to their financial crisis lows of 2008, although for all that, they're only down by 4 or 5% over the past year, which is actually a little bit better than the FTSE 100, so it could have conceivably been worse. Perhaps investors feel that the management team of Steve Rowe, Chief Executive, and Archie Norman, Chairman, is finally taking the really hard decisions at the firm, including those cost cuts and also an initiative to improve its online offering through the deal with Ocado that was announced back in February. M&S will buy 50% of Ocado's food retail business and get the benefit of Ocado's logistics software and technology in exchange for paying up to £750 million. M&S is funding that outlay with a £600 million rights issue, the timing and terms of which are yet to be announced, and also that dividend cut, and again, more on that in a second. M&S does need to improve its online offering. M&S.com has suffered from technical glitches and is growing at a relatively sedate pace compared to many online rivals. Using the Ocado platform could be a big jump forward. Broadening out its online food offer is a potential further avenue for growth and one that gives M&S further opportunities to reassess its physical footprint, even after the store closures already announced. The risk here, however, is that current Ocado users, of whom Mrs Mould is one, defect to Waitrose.com or other rival offerings if they think the M&S range is too limited or too expensive for them, and they are issues that Mr Norman and Mr Moreau may have to work to address. You can also argue that the food arm does need that fresh impetus. January's third quarter results showed the 8th consecutive year-on-year like-for-like drop in food sales. Clothing and home also racked up another decline, the 8th in a row and the 14th in the last 15 quarters. So, the first number that analysts will look for is the fourth quarter like-for-like growth numbers. For the record, food fell 2.1% and clothing and home 2.4% in the third period. Attention then switched to the pre-tax profit number. Now this is going to be messy. It was a year ago when Mr Rowe and Mr Norman stunned the market when they announced a store closure programme and a £514 million exceptional charge for the year to March 2018. The first half numbers for this year just ended featured another £97 million of restructuring related and other costs to take the total to exactly £1.5 billion over a 7.5 year span. Now there could have been more of these costs in the second half, we'll find out, but on a headline basis, analysts are expecting pre-tax profits of around £520 million compared to just £67 million a year ago. But if you strip out last year's huge charge, the base for comparison is more like £581 million. So, analysts are looking for another drop in full year profits. And for the record, in case M&S gives any forecasts for the year just beginning, they're looking for another drop to around 512 million for the year to March 2020, before a tiny bounce to 520 million in the 2021 financial year. Now, perhaps one positive sign for shareholders going forward would therefore be a reduction in those supposedly exceptional costs and a closing of the gap between reported and adjusted numbers. That could point to the potential for improvement in performance and that the quality of profits could be improving as well as the quantity. Attention will then switch to the dividend. M&S has already announced that it will cut its dividend by around 40% for the second half. That implies a full year payment of around 13.9 pence a share, and then something presumably like 11.2p for the year that's just beginning. If analysts' earnings forecasts are correct, that will take earnings cover back to around 2 times and leave the stock on a forward dividend yield of around 4%. Thank you for watching, and I look forward to seeing you next time.